everybody. Thank you for coming today. My name is Christine. I'm with Realty One Group Sunshine, and I am so happy that we're able to gather today and talk about the lending relationship between realtors, lenders, and title companies. This way, you get a behind the scenes of what happens when you're working with these partners and the intricacies that happen within the market. So we're going to be talking about the lender side of what the rates are looking like, how they usually help us when the transaction goes in, and more information on certain programs and requirements that is new information or just information you just haven't heard of yet. Today with me, I have Josh Naylor with Naylor Mortgage Group. I have John Ricker with Baxter Title, and I have Mike Symbol with Regions Bank. Thank you, guys. And I am your reliable realtor with Realty One Group Sunshine. So to kick it off, I just want to say that when working with a realtor, a lot of the times it gets overlooked that you have to start with a pre-approval or figuring out what funds you have accessible to you in order to go and find the home of your perfect value. And that tends to put a lot of realtors in a difficult situation because we want to show you the right home, but we also don't want to go and show you homes that are outside of your budget or your wherewithal. So it's nice to be able to partner with a lender to know where exactly your budget lies and to understand what opportunities are available to you, because there are programs, there are assistances, and that's really what we kind of want to break that barrier down for you to understand, because there's just an extra route that you can go on to understand what works for you, and we want to help bridge that gap today. So to get started, I will go ahead and pass it off to Josh to give you the introduction of where we are with like the lender pre-approval, how that relationship works when, or if a realtor does end up sending you off to a lender just to get more information, what that looks like and how that works.
A big part of that is starts with the conversation. Conversation is just, kind of find out what your goals are, what you're looking for. If you're trying to, purchase, is this a long term or you hold on to it? Rates are expensive right now, so that's another thing we go into. We really streamlined the process and made it as easy as possible. And, you send somebody to the website, they get online, fill out the application. I follow up with the conversation with them, go over some things, get all the information, docs, all that stuff. I'm really as much of a financial advisor as I'm a lender. I'll go through it. Your mortgage is always going to be more than likely the cheapest thing that you finance. If you've got a lot of bills and debts and things that you're paying a lot more higher interest rate and you want to put more money down on a house to save yourself, we'll look at it and go through the numbers, see if that makes sense. Or if, buying down this, paying off a credit card and saving yourself $300 a month on that and, doing things like that. I mean, it's definitely a process, and everybody is different. Depends on, what they're looking for and what their goals are.
Perfect. And then Mike, for you, since you do work with the bank side of things, and they're really more structured and funneling in new clients and everything, if someone was interested in working with a bank to go through their loan, can you tell us a bit more about Regions and your process?
Absolutely. So working with Regions, you don't necessarily have to be a Regions customer to work with me. The more the merrier. We're actually, as a loan officer, we actually bring in more outside customers than the actual bank does. So they look to us to grow the outside households and the new households. Working with the bank, a lot of the referrals do come from internal sources. We do have branches that we cover. And the benefit of working with the bank is that you maintain the relationship that you already have with Regions or with any bank that you work with, and you get to keeping everything in house. I'm sure Josh can attest to this, but the same thing he just said. We figure out what people's goals are, and we make sure we get them in the right product and with the right rates, and making sure that their affordability and what they can afford and what they want to pay on a monthly basis kind of match up. That's something big to point out, is that people's affordability what we can qualify their income and their assets to cover and qualify for is completely different from what they want to pay and what they want to have as their incurred debt on a monthly basis. There are certain things that we have control over. Um, I'd like to say we have control over rate. Unfortunately, we don't. But there are ways to finagle rate to make sure that it works for what people are wanting to do and their long term goals, whether it be a fixed rate or an adjustable rate, and how long they're keeping the home and what their long term goals are. So again, like Josh said, we're financial advisors just as much as we are lenders.
And with getting involved with the relationship where it comes into figuring out their ideal price point and not being able to pretty much give them the rate that we want, since we're well past that 3% we saw not too long ago. And we just had that news report yesterday that came out. Can you guys give us some insight on what you saw on that report for the rates?
Ultimately, it was a lot of good information. I was really scared Powell was going to be a little more hawkish in his rhetoric and kind of outlook and everything. But, I think he's really doing the right thing by, keeping us on pause, checking, making sure the market's headed the right direction. We've had some softening here recently, which is a good thing. They want to see the jobs report come a little bit lighter. Ultimately, I think it was all good things to point us in the right directions of potential rate cuts. I don't think we're going to see rate hikes. And if we see rate hikes, it's because we're way too hot. And being too hot, I mean, that's a good and bad thing. There's so much that goes into this stuff. And all of it is directly related to interest rate and affects rates. The 10-year moves up and down all the time. And that does correlate with your rates and everything. So, I mean, I think it should be good in the near future, I'd say.
I just think over the last couple of years after we saw those 3% rates, I liken it to a pendulum where we've swung so far one way that when it comes back, it's going to swing really far the other way. And I think we're in that time frame right now. And it used to be we saw rates, going up, going up, going up, and there was always news rates were going up, going up, going up. And now we're starting to get to the point where we're seeing news where rates are projected to come down. So it got to a point last year we were at a certain point where when they said there's no news used to be good news, and we would see a rate, softening and decrease. Now we got to a point where no news is now bad news sometimes. And so when Jerome Powell comes on and isn't hawkish and has information for us and provides actual reasoning behind certain things, like we saw yesterday, rates actually went down slightly. So we're getting into better news cycles, and we're starting to see a softening in these rates and people coming back into the market.
Perfect. So with understanding how the rates are currently working and that they do fluctuate, it's always important to understand that you are dating the rate and marrying the house, which means that there are opportunities if you do lock in a rate at this point right now, that there are opportunities to readjust that. And I'll let Josh kind of go more into the refinancing side.
Man, I tell you what, refinancing or like buy downs?
Yeah, both, please.
Yeah, well, I tell you what, it's been, I would say, the year and a half of just creative lending. And creative lending just kind of comes down to, how do we make this loan more affordable for the time being, knowing that we will see some cutting in the very near future. I thought we would see it sooner than this, but it's ultimately a good thing because we were expecting a bit of a recession, hard landing, something that, we're going to see a disruption in price, all that. Really hasn't happened. So really, we've lucked out in that aspect of just the economy in general. But what we've really done is been creative on buy downs. Buy downs look, they're very different. It starts with a 3-2-1, a 2-1, or a 1-point buy down. 3-2-1 is 3 points off your first year, 2 points off your second year, 1 on your third year. Yes, third year. And then you go back to your original rate. And we really like the 3-2-1 can be expensive. The 2-1's a little bit more feasible. If you're at 7, brings you back down to 5. You end up saving, I don't know, roughly $600 on $400,000 house. It's really about making it more affordable for the time being. And these are credits, actually. These are credits towards the buy down of your loan for the time being. So if we get to where we're down 5%, I don't know about 5 in the next year or so, but at least a point less, and you want to refinance, you might have some credits left over from doing a buy down, and you just apply that to your refinance, which is going to make it more affordable for when you are ready to lower your rate for the term of your mortgage.
So when it comes to buying down rate, I know I don't personally have like a 3-2-1 buy down or 2-1 buy down. Typically, what I try to get, and we're seeing more of, are seller credits, and I try to work with my buyers agents more and more to say, instead of asking for reductions in prices, have them kick back some seller credits to you, because typically you could buy down a rate and have a much more affordable mortgage than should they lower the price $10,000 if they kick back half of that. So I mean, there's different rules for different types of loans on how much a seller can concede to you in concessions when it comes to buying rate or closing costs. But it's certainly something to look into. It typically doesn't cost a whole lot to buy down your rate, depending on where you want to be. And, I work out what I like to call my break-even schedules that I manually put together for people. And I show them how long it's going to take them, should they lay out money for closing costs or for buy down, to, quote unquote, break even.
Yeah.
So you're saving that money on a monthly basis, but you're not recouping that whole amount, for maybe 2, 3, 4, 5 years. And, everybody is expecting to be able to refinance these 7.5 point rates, within the next 3 to 5 years, hopefully. I mean, I'm hoping everyone can. So typically when I'm advising people on their own out of pocket buy downs, I try to find their sweet spot about 2.5 years or so. And what that really does for them is lets them know, yeah, I know I just paid out closing costs for this house I just bought today, but this will prevent me from buying down the rate will get me into the zone where I won't have to do my refi for 3, 4, 5 more years down the line, because I already have the rates that are coming down the line. And typically, once you hit that break even point and exceed it, you're saving money you've now started saving money on a monthly basis. You're keeping money in your pocket. That's certainly one way to do it. The other thing is I started to advise folks more on adjustable rate mortgages. Again, back to the point that we think that we should be able to refinance within the next 5 years or so. So I know some folks are afraid of, they don't like that word, the adjustable rate mortgage, because of what happened in 2008. But the whole idea behind that is that, one, you're likely going to refinance in the next 5 to 7 years, and that prevents you from having to, have that forcing you to refinance if you have the lower rate already, and you're saving money in that span. And the second thing that it does for you is really set you up knowing that even if rates happen to tick up and you have that adjustable rate, it's preventing it from ticking up massively. It's only tiered up on it. It's only increasing slightly every 6 months to a year.
Okay. And with knowing that there's options with buy downs as well as seller concessions, when and where do you really get into with your client about which loan really works out for them, whether it be conventional, FHA, jumbo loans, all that options that are available to your clients?
It's really about educating people on the difference of these loans. Conventional is expensive nowadays. I mean, it really is, just because rates are really high. And the thing I'm not the biggest fan of with conventional, there's no streamlined process that's associated to it. So FHA has a good program. It's called a streamlined refi. You don't even have to show new income, very limited documentation at all. As the whole purpose of it is bettering your current situation in this FHA mortgage. You can refinance, and as long as you're down a point or whatever it is, it's pretty much a streamline. It's minimal cost to you out of pocket, and that's something I go over with people. Especially if it gives you the opportunity to get, if you're not a first time home buyer. With some first time home buyers, if you haven't owned in the last 3 years, you could do what's called a 3-point conventional loan. Aside from that, there's FHA that's 3.5% down, And that just helps you get into a property. And like I said, if you hold on to it and you know you're not going to be under 80% in the next 5-10 years or something, I mean, there's no reason not to do a FHA. I mean, it's a little cheaper. The refinancing is a lot easier, streamlined. It's just a good option sometimes. It's just something to go over. And again, it's about weighing out the options. It's everybody's different, situation's different. It's just kind of what they're able to do and what you want to do in the very near future.
Yeah, I think it comes back to the initial conversation you have with someone when you're finding out what they do for a living, what their goals are. You could kind of figure out which products suits them the best. Some folks, only fall into one category. They only qualify for an FHA loan because there's some flexibility. They're a veteran and they don't have funds for down payment, so we want to do the 100% financing for them. I know I offer a physician's loan, a doctor's loan. For those folks, we go up to $1.25 million, 100% financing. So for some folks, like when it gets to that price point, it's a no-brainer to keep some of that money in your pocket, especially with everything that's going on inflation-wise. Everybody needs more cash in their pocket. So it really goes back to that initial conversation where you figure out their goals and what they're looking to do long-term with this. It just really, figuring out what suits them best. And, some folks do fit into multiple categories. So providing them those options, saying, if you go this way, you have this type of flexibility down the line. If you go with this other loan, you can do this things in the future. So there's a bunch of different ways to proceed for different folks. And it's really, again, figuring out just what suits them best and what's best for them. As far as FHA and VA, I love doing them. I have no problem helping a customer out, especially if that's the only way they qualify. I think some of the hurdles we face as lenders comes back to that relationship with the realtor. I think we went through a period, especially during COVID, and especially in our area, we do have some aging homes, and some of those things make it a little bit more difficult for VA and FHA appraisals. So it's working. That's where our teamwork with the realtors come into play. It's like we got to make sure that if we do an FHA or VA loan, that everybody's on board with what's the requirement in appraisal, especially for that. So that's how we kind of figure out exactly what works best for everyone.
Okay. So I've had a few out-of-state buyers looking to purchase in Florida, and they're looking for either programs, assistances, and a better way to kind of position themselves in the Florida market. With what you're seeing right now, what would you recommend for either first-time home buyer or they have purchased a home but it's their first home in Florida?
Yeah, I guess the only unique thing about Florida is you get homestead. Yeah, there's grants and things like that for first-time home buyers. The thing that I always warn people about those, especially if you have the money, it's one thing if you don't have the money, which gives you the ability to buy it and you want to do the grant. So that's great. But a lot of these grants, they're repayable. You have to pay them back. And that might put you in a bad position when you go to refinance. It'd be one thing if we were in a market where we knew rates were kind of where they would be over the next 5-10 years or something. But if we know they're going to come down the next couple of years, you're going to refinance. Now you're going to have to pay that money back. And that's something to definitely have to think about. And refinancing, I mean, it's, everything's worked off LTV, loan to value. And that's a big part of that.
I would say the same thing. Really, there's for the folks that absolutely need the assistance for closing costs and down payment. There's plenty of programs available, but I always tell my customers, especially the ones that don't necessarily need it, that we can figure out how to get it done without them. It is not free money.
No,
it goes on as a lien on your property. You're going to have problems down the, especially with everybody's home prices going up. Everybody wants to access their equity. That's pretty much the only place they have cash in hand at this point. So if you have a second lien on your property, it's almost impossible to get a HELOC. You're going to have to go find a special lender that's going to put a third lien, which I don't know anybody that does that.
No, that's not
so,
and just think of it like, it's you're investing in your home.
Yeah.
Put some money down if you can. I mean, it's a good investment. It ultimately is.
Yep.
Statistically, you're going to get your money back.
Absolutely.
Yeah. So, don't be afraid of that part of it.
And to get John involved.
Hey, John, how are you?
Good. How you doing?
We're going to start switching gears into the behind the scenes of what really happens in our communication with your lenders. For me personally, when I reach out to a buyer that's interested in properties, I go ahead and start checking their to-do list of diligence. Did they go ahead and look at their options with their lenders? If they haven't been in contact with a lender, I go ahead and send them a few referrals and let them shop the rates and figure out what program works specifically for them. But my course in this is to just kind of facilitate that connection with the lenders and make them understand that there's a benefit of learning about these options and connecting them with knowledgeable lenders that can help them in particular with their specific situations, and just staying on top of that communication, because once I do connect with them and a lender, we have an awesome way of communicating just by checking in, getting updates. They let me know exactly where they are in the process and what they can afford at a higher dollar level that's actually accurate, which helps us find the best home that's suitable for them. And on the title side, take it away, John.
Well, what we do is we have to work very closely with these gentlemen and their companies. So when we get the contract in, first thing we do is obviously order a title search. Order a title search. When title search comes back, we then issue to their companies, whoever their regions, whoever you're using as far as a brokerage. We have to issue them a title commitment and a CPL. CPL is a closing protection letter, and really people don't know behind the scenes that is actually a contract between our title underwriter and the lender to protect that loan under with title insurance. So that's how that all starts. Then we wait, we go through the process. We wait for Josh or Mike to call me up and say, yeah, we got the appraisals in. We order the survey. Survey's ordered. We keep moving along, and we wait for these two guys to call and say, we got the clear to close. Then we get the balance with their inner office, what we call CD. We have to balance the CD with them to make sure all the numbers are correct, because we are a third party, disinterested third party, right? So we have to, we care about both sides of the deal. So we have to make sure that the buyer is not, there's no secret or hidden charges in there or anything like that. And we have to balance. So the loan does not get dispersed and the home does not, the transaction doesn't get completed until we are balanced with the lenders. We have to balance, go back and forth, say, okay, we're balanced. Boom, send us the package, get the closing table, everybody signs, happy, and we're out the door, handing keys.
Yep.
Awesome.
That's
I
pretty
will
much
say these guys make it
Yes.
really easy. We just did a deal this last week. I mean, we got them the packet the day of, and we closed 3 hours after that. I mean, that does not happen very often. That's awesome.
Thank you for that plug. Thank you for that plug. But
Well, absolutely. Choosing the right title company is very important because they have to be hands-on. They have to understand what's going on in both sides with the inspections, how the home is moving forward with the banks or with the lender and how they're getting the financing for the home, and just making sure everything is documented, everything is legal, which is super important, and then helping us transition into the new ownership and getting everything documented and passed on. So
absolutely, that's the name of the game right there. That's how we make it happen. So communication is key. Have to have communication, and we pride ourselves on that. You coordinate with usually 5 different people on a transaction, right? You have your listing agent, your selling agent, your lenders, your survey people, your inspection report, and then obviously the 2 customers, the seller and the buyer. So communication is in total what we have to do and be on the same page.
Appraisal, we have insurance,
right.
and we have
Insurance, and that goes back to balancing that CD at the end, making sure everyone's getting paid. Right. So that's what we have to do. We have to make sure everyone's getting paid. The homeowner's insurance is paid. All those things happen at the end with title. And that's our behind the scenes. So after the homeowner leaves with those keys and everybody's happy, we get to the real work of dispersing the money and sending everything out, including obviously the proceeds to the property to the seller. Right. And then it moves on from there and paying all the insurances, appraisals, anything that was left in, anything we have an invoice for, including our title search. We have to pay the doc stamps to the county,
IRS.
recording fees, IRS.
We just had a deal where they're taking care of IRS for the buyers. I mean,
so there's a lot involved, and that's what it all comes down to at the end.
awesome. Well, also on the reeling back over to the lender side of things, I know we kind of briefly talked about the programs, but if there are any down payment assistance programs and those type of things, where do you recommend for like Pinellas County? They just go to county appraisal, or not appraisal, just county sites, or where do you recommend they look for these, or do you have any in-house opportunities?
I know, realtors that are experts at that and who to go to and who to find, and I would absolutely recommend that to my customer. I won't sit here and say I'm an expert on down payment assistance programs, but I know where to get the answers from. Internally at Regions, we do have what we call a CRA lender. She's a community resource lender, and her expertise is going and finding these programs and where to find them and where to get the money for them. A few of us, nobody can see who's here, but the few of us that are here know also other lenders that are experts at these. And even though I work at a bank and I work for a sole lender, I have partners in other banks and other brokerages that have no problem helping me, referring who I need to go to help me get the deal. And it works both ways. I certainly help them. So there's certain ways to help the customer and make sure that the customer is getting everything they need to make sure that they could close on the loan, on the property that they hope that they could buy and they want to buy.
Yeah, we have a list of a bunch of different programs, and some of them are set up by county. I mean, well, counties, and then also zip codes, and they're really trying to do disbursements and incentives to certain areas to build up and all that stuff. I mean, there's a bunch of online opportunities to get on there and kind of find what fits and looking in different areas. There's a lot of information on that out there, and we've got contacts with it. It's just a matter of kind of what fits for you. And a big part of that too is income derived, and you have to be in a certain income level. That's a big part of these programs. They're just not available to anybody and everybody, as they shouldn't be. But yeah, that's a big part of it as well. And
A lot of municipalities have their own too.
Yeah.
You have county programs, you have municipality programs, City of Largo, City of St. Pete. A lot of those are, we do a lot, obviously on the title end, we do a lot of those closings at the end with City of Largo. And like Josh said earlier, remember that a lot of those are paid back. That is a second mortgage. We're actually running a second mortgage from the City of Largo that is being attached to your house as a lien. So just remember that when it comes to the down payment assistance program.
Yeah.
It's not all free money.
No.
If only.
No such thing as free
No
money.
such thing.
No.
It's free money.
But a lot of the searching does start with the interested person that is looking for the homes and doing your due diligence and understanding like where you kind of fall in these categories and brackets, and being able to just kind of relay that information to us so we can do our job and make sure we find the best programs for you and understand where it is you're looking for, so that way we don't miss anything. We can actually provide full service and dig in deeper, because there's just so much we can tell from just looking at bank statements and financials. There's just opportunities that the county offers if you're like an artist, and we wouldn't know that by just looking at your income. But if you mentioned it and we could find a program that works for you, that is something that we definitely would like to work for and work towards.
That's why having a relationship with a lender and a realtor is very important. It's good to collaborate on this stuff, get on the same page with people. And I've got a little more flexibility on programs like the SCR investor loan. We've got bank statement loan. We've got 1099 loans. I mean, we've got some creative stuff. I mean, it's all about finding the right loan for the right person in the right situation. And it really is. And I always consider it as, fitting a square peg in a round hole. You just got to get creative enough and work the numbers, blah, blah, blah. And that's why having these relationships, and then let her know, hey, we need a little bit of closing costs. Mm-hmm. These closing costs will help buy down this rate to make this a little more affordable to them with their DTI and put them in line and so forth. That's, those are big differences too with different programs. Conventional, you can't exceed 49.99%. FHA is good because you can go up to 55, 56% back-end ratio. Just a little more flexibility. Again, depends on their needs.
It comes down to, yes, relationships are key. People want to work with people they like, and they trust people they like and they have built relationships with. Having, availability. It's the old sports adage, the best ability is availability. And if you have a lender that you work with or a realtor you work with that you could get in contact with, pretty much any time at night, and like we like our peace and quiet also, but knowing that
I don't know what that is.
yeah, right. At this point, no one knows. But it's like knowing if there's something going on in the loan that you could contact the lender or the realtor, pretty much any given time to make sure things are moving along the way they're supposed to.
Right.
So and having that relationship and then, referring your customers and trusting your customer with this other person that you're referring them over as an extension of you. So creating these relationships between, all the interested parties that we have or uninterested parties. It's like, disinterested parties. Yes.
Not uninterested.
Not uninterested, disinterested. I'm sorry. It's key to have people in different fields of this, of this business that you can trust. Yeah.
I mean, it is a process.
It's an absolute process.
Definitely a process.
And with that being said, sorry, I got spaced out there. With having these relationships and knowing that, like, I can only do so much without my team. And there's absolutely, like, through the whole transaction, I will communicate with title and lenders at the same capacity, even if they don't need to fully know about it from the other person's end. I still want us all on the same page, because of that way we get a smooth closing, we get to progress very easily, and that communication just builds trust within this difficult transaction, which does tend to not go as smoothly as we expect. And when that happens, I know we end up looking at the bottom dollar and what the factors are and what we're coming to the closing table with. And that does get prorated through timing. So when dates change and things just are out of our control and we have to adjust, we make sure that we're in constant communication, updating those prices, making sure you know what you're coming to the table with. And that's really important at the end of the day because of how large of an investment this is. And title has a huge part in allocating all of these funds and making it very easy to understand what you're going to need and what I'm going to have to do to end up making this transaction work seamlessly. So I do believe in the relationships that we've built, the communication we all have, and the fact that I know the team I have diligently stays on top of their game and looking for new information, better ways to help our clients, and just what we can do to make everything work smoothly and effortlessly. As I recently just posted, I think yesterday, that the Homes for Heroes program, Hometown Heroes program, just became refunded and will be available on June 1st. And it's not limited to the essential workers anymore, but to brick and mortar employees. Do you have more information on that to piggyback on?
Get it quickly. It'll probably be out by June 2nd.
Yeah.
So, I mean, essentially that money comes in so quickly, and there are, lenders that, really focus on it and know and sit and lie in wait until that money is released and then lock it up as soon as possible. It moved again especially since they opened it up to pretty much almost everybody that works in Florida. It goes so quickly, and it's just, it's another one on the list of these down payment assistance programs that if that's really absolutely what you need to qualify, then we're going to have to make sure that we do our due diligence and make sure we're ready to go.
That's what I was going to say too. I mean, I understand, that's a great incentive for somebody to get a little more motivated to buy a house, but don't let that stop you. I mean, again, this is an investment to your life, your family, everybody. I mean, this is something, hold on to it long enough, you can pass it down to your people. It is generational wealth. It is. That's one of the few ways and we make it easy for you to get it. Just a matter of getting on the same page and building the right opportunity and loan and putting you in the right position, one for now, and then also looking into the future.
Absolutely. And when Josh mentioned that the homesteading option or opportunity that's available in Florida is really important to be aware of and to know how that works, because it will help with your taxes and knowing how to align yourself for future success, and then switching it into like how are you going to hold your property for the future and to be able to do that. So we will have topics on that and on our next in the market meetings and get really in depth about
To
how to
graze
wrap it
over
up.
that, yeah, to graze over that, just a quick example. If you bought and owned prior to 2020 and you were homesteaded, and look at the prices of houses that have just gone up, the taxes went with it. They stayed at a pretty steady rate. Theirs didn't move up near as much as these new home buyers. So that is a huge incentive. And that's why it's important to get into a house sooner than later. Another reason.
I was touching that real quick. Homestead, super important because, like Josh just said, you bought in 2020. When you are homesteaded, the max your taxes can go up is 3% a year. That's it. That's the max, and it never hits the max. So you're locked in basically at that tax rate for the rest of your life, and the most you'll ever go up is 3% a year at the most. So it's super important. We make it a habit at Baxter Title to say at the closing table, make sure when you go change your license to your address, walk right over and do your homestead at the same time. It's really that easy. I mean, but people don't say it. People don't know. They have no idea. We're in an online age. Everyone wants to do it online. It's super simple. Right at when you get the county clerk, when you get your driver's license changed, go walk right over. They're sitting there waiting for you to come and do your homestead right then and there.
Yep.
That's a big one.
Absolutely. And that's why it's important to have your knowledgeable team, because it might be something as small as just walking to the other side of the DMV to get that adjusted. But when you work with people that care, we're focused on you getting the best out of your home ownership opportunities, not just closing a deal and not just getting you into a house. We want you to be productive as well as just like thriving with this opportunity. A home is an asset as well as where you go to bed at night. So we want to make sure that you're putting your best foot forward at the beginning as well as like through the process. Does anyone have any questions? Any questions on loans?
One thing I don't think we touched enough on, I would say, just because it was in our notes and stuff, down payment options and things.
Yes.
Okay.
That's a big part. And, I guess I mentioned a couple of times, but, conventional has a handful of different options. The least one they have is 3%, which is a first time home buyer. And there's some incentives built into that actually you get a little bit better on your mortgage insurance too. So, I mean, it's a bit of a better rate, a little bit better on your mortgage insurance. 3% down. It's really a good loan for a first-time home buyer. That's actual good first-time home buyer. Aside from that, then the next one is FHA, 3.5%. That's great. You've got a little mortgage insurance. It does stay with the property, the life of the loan. But again, it depends on how long. It won't drop off till you're under 80% LTV. We've been in a market where that's happened so quickly. That is not normal. It typically takes you a handful of years for you to get that low. So, that's something to even think about, talk about, having a quick question, just educating. Aside from that, 10% is kind of a good range that I really like. A second home is 10 to 15, 20%. You're going to get the sweet spot on putting money down is going to be about 25%. That's the least amount of risk to the bank and, the investor and all that stuff. That tends to get you the best rate. Thereafter, obviously it's better and better, but 25 is kind of that sweet spot.
As far as down payments, yes, like Josh said, conventional you can go as low as 3%, FHA to 3.5%, and depending on what other certain products there are out there, sometimes we allow for people not to put any money down.
VA, USDA. I forgot about those. Those are great.
Internally, we have some portfolio loans for low to moderate income borrowers that, if the house is in a specific area or the customer's income is within a certain range, typically it's below 80% of the HUD minimum HUD income for the year. We offer, certain different products that have reduced income with no mortgage insurance. So it's really, again, figuring out the customer's, perfect scenario, what gets them, the best rate long term, if that's what they're looking for, the lowest payment long term. I think that putting the 20% down obviously helps you avoid mortgage insurance on a conventional loan. And I agree with the 25% sweet spot. The other added benefit of the 25%, if you are buying a condo, which we all know is huge here, and there's all other sorts of problems, especially in their financials. Putting that 25% down allows us to, avoid looking at certain items on a condo underwrite.
Review.
Yeah, limited review. And again, we don't have to look at financials then. So if, there's reserve issues or, there's when the assessments that are coming down, those are all things that, kind of get overlooked when you put more money down and you have more skin in the game. So there's a lot of different value to different, products that we have, and moving your money and putting it in the right place at closing or during the underwriting process, so we know exactly where you stand when you're ready to go or ready to close on the loan.
What's the major difference if you were to approach a condo that somebody's buying or a single family home finance? What are your biggest challenges?
The additional requirements that are, needed to go through for approval. When you approve a single family home, you're qualifying the borrower and the house. When you're qualifying a condo, you are qualifying the borrower, the condo, the management company, their insurance, the shared space,
Reserves.
financials, reserves,
Yeah.
how many rentals,
have an offset of
just a
rental
whole litany of things that go along with that. I mean, personally, I could speak to a situation where, if there's a lawsuit going on at the community, even it has nothing to do with the property your customer's buying, it has nothing to do with your customer or the seller or any of that stuff, it could still prevent, an issue coming up because they're potentially having to pay out for something, so that could affect the reserves. And the longer I've been doing this business for the last 6 years plus, it's really coming to a point where it's like every single day there's something new they add on to the requirements that they need for condos. And I think the realtors in the room here could attest to that condos are a fun project, to say the least.
Yeah, there's
Condos are tricky.
Right?
Oh, absolutely not.
And that's the other thing. We do unwarrantable condos.
Yes, we do non-warrantable condos.
Oh, you do?
We absolutely
Cool.
do. Yeah, with a lot of our portfolio lending is non-warrantable. It gives us the flexibility to overlook one or a few
When
items.
you say unwarrantable, what does that convey? What does that mean?
I mean, to put it simply, it's something, conventional underwriting won't approve. Fannie Mae or Freddie Mac won't approve it because it doesn't fit into their mold of what they're requiring.
Take everything into consideration.
Absolutely.
Well, it goes back into the condo questionnaire and making sure they have enough reserves, insurance coverage. They're not overweighted on investments. And
that determines
that's part of
whether
the
they're
unwarrantable part of it. Yep.
But that also comes down to having a good team also, because if a realtor is showing, their customer a condo, they come to a lender and ask them, like, what are you guys looking for to get this done for us? And they're already doing, I'm seeing more and more of this. Realtors are doing their homework on the finance, things that are publicly available without having to pay for a questionnaire. Financials, the minutes, this new engineering report that's required, making sure appraisals and insurances are up to snuff on what's required for us as lenders.
because it could be an issue.
Absolutely. We warn people. We try to warn people as best we can. I mean, there's always kind of hidden, landmines sometimes until we absolutely get into it. So there's never, 100% saying, hey, it looks like we could get this done, but there more and more things are popping up. So it's key to, have that team that's looking at these things in advance and knowledgeable about what's going on and which products could get through these certain hurdles that might pop up.
And with the PMI for getting a lower down payment, does that usually change with from a 10% to a 5%, or once they're below a 20%, it's just one
definitely. The more money you put down, the less in mortgage insurance. That's why my personal sweet spot is like 10%. I like 10%. 10% down, you still get a little discount on your rate. You're paying a little bit of mortgage insurance. You've already taken some off your principal. I mean, you're more likely to drop off your mortgage insurance quicker, and you don't have to put a bunch of money down all at once.
Yeah, touch on that real quick. I was just at another seminar earlier this week, and the national average of homes requiring more equity is at 4.9% nationally. Here in Pinellas County, 9.8% a year. So just what he just said, what Josh just said, if you're in your house and you put 10% down, get down to that 20%, might take you a year 14 months,
Yeah.
and that PMI is gone.
Yeah.
In
That's
Pinellas
awesome.
County, the way we're going right now.
Yeah.
And nationally, it will take you 2 years. You know, so the values are just, they're increasing and everything's looking great on that end.
Right.
So again, his point, put more money down, you'll be out of the PMI faster than ever before.
Additional ways to avoid mortgage insurance is what we call lender paid insurance. So mortgage insurance is essentially exactly what it sounds like. It's an insurance policy that you're not going to default on your loan. But if for some reason you do, no lender wants that. That's not our goal. We're not in the house business, in the real estate business. We are in the loan business. But we have that policy in place for a reason. But we do offer what's called lender paid, where essentially the lender pays for that policy on your behalf. There's obviously a cost associated with that. But if we go back to what we spoke to and touched on initially, where we have some like seller concessions up front, that's something that you could actually pay into, where you're not necessarily lowering your rate to have a lower, principal and interest payment, but you're removing that mortgage insurance payment because you were able to cover that cost. So even though you don't have a lower rate, you are still saving, $100, $200 a month potentially.
Yeah, there are ways to get out of mortgage insurance.
As lenders, we're puzzle masters.
That's right.
We don't provide, we require, everybody else to provide us the pieces, but we sit here and we figure out how the pieces fit together best for the customer.
Awesome. I know we talked about down payment. Did we have any other routes that we talked about before, Josh?
Anything title related?
No, we're good.
Well, title, I really enjoy the team effort that Baxter does provide to get information before we even put in a contract on a home. There's a lot more opportunities now for us to get insight and information before you put in an offer. So I do appreciate that from the title side of things. That makes my job a little bit more efficient and better for me to help explain information to you when you end up looking at a home or you have questions about what's going on with liens or just anything on that property. So I just have to give a shout out to Baxter on that end.
Yeah.
But yeah, well, thank you guys for in the market this month, and we will have our little out of the market luncheon on our following Thursday on is that the 18th? I think so. We'll double check. It'll be on the Facebook group, and I look forward to talking to everyone there. Then we get to have more information and insight on what we're looking for, on what we need more information on, and a little bit more of a leeway into our next month's meeting that will be posted as well on our Facebook page. Once again, huge shout out and thank you guys, Josh, John, and Mike. And
It's been a pleasure.
yeah, thank you guys. You can go ahead and hit the red buttons. Thank you guys.
Awesome. Good job, bro. Love it. Yeah.